There's someone who wants silver right now, and there's tightness in the silver market. The leasing rates have come down, but last couple of weeks ago, they were as high as what, 100%, 200%, as we were $3 in backwardation. Speaking of extreme stress, now we're not there yet, but the fact that we're almost at the declaration point and we're in a backwardation tells you that there are big people, and the December contract's a biggie because it's delivery for both gold and silver. The fact that the gold market is saying everything's okay, I guess. The silver market's saying not so much. There's not enough supply. There's more physical demand than there is bars to satisfy those contracts. I think it's going to get kind of interesting over the next 9-10 days. We'll see what happens, but I think it's going to be a huge delivery month.
Something is happening right now in the silver market that we have never seen this close to a major delivery month. Not in modern history, not in the last decade, and not even during the 2020 liquidity crisis. While gold is calm, orderly, and behaving exactly like a healthy futures market should, silver is flashing the loudest warning signals in the entire commodity sector. We're talking about backwardation returning just days before delivery, lease rates recently exploding to triple digits, and physical demand so strong that even a massive 50 million-ounce shipment to London barely made a dent. And wrapped around all of this is a new geopolitical layer. The U.S. officially declaring silver a critical mineral, and China answering with strict export controls on every ounce that leaves the country today. We're breaking down exactly what these signals mean, why Andy Schectman believes silver is entering historic stress, and why this moment may be the most important setup precious metal investors have seen in years.
Gold is in contango. Contango is a normal market function where the spot price is less than the futures price. Typically, when you're talking about any futures commodity price, you're paying for the storage, the interest expense, the cost of money. The further out you go, the higher the cost. So, you go out 2 years and the spot price may be 4,500, 4,600, whatever. The further out you go, the higher the price should be. That's normal. On the 28th of this month, in 9 days, those who hold long contracts have to declare, well, not they don't have to, but they typically do on that first day, declare if they are going to roll it, cash it, or stand for delivery, right? So as you get closer to the delivery date, that spread will narrow and narrow and narrow to it should get even with spot, right? What we see in silver is the opposite of that right now. It's a 26-cent backwardation. We're back in backwardation again, which we saw remedied briefly by 50 million ounces sent to London. And all of a sudden, within a few days, backwardation started to rear its head again. They basically plugged a gaping hole with bubble gum and baling wire. And a 26-cent backwardation in the spot price, futures price, this close to options futures expiration 9 days away, tells you that there's someone who wants silver right now, and there's tightness in the silver market. The leasing rates have come down, but last couple of weeks ago, they were as high as what, 100%, 200%, as we were $3 in backwardation. Speaking of extreme stress, now we're not there yet, but the fact that we're almost at the declaration point and we're in a backwardation tells you that there are big people, and the December contract's a biggie because it's delivery for both gold and silver. The fact that the gold market is saying everything's okay, I guess. The silver market's saying not so much. There's not enough supply. There's more physical demand than there is bars to satisfy those contracts. I think it's going to get kind of interesting over the next 9-10 days. We'll see what happens, but I think it's going to be a huge delivery month. It was kind of like the U.S. Silver is now a critical mineral. China said, we agree with you, and we are going to limit exports to the point where every ounce that leaves China has to be permitted through Beijing. In other words, the government will say what goes, what doesn't go, and the free flow of silver, which China's a big exporter, a huge refiner, will put greater strain on the LBMA because they were one of the exchanges, the Shanghai Metals Exchange, that sent 20 or 30 million ounces to London at supposedly very high lease rates in order to plug that gaping hole with bubble gum. It obviously is leaking again. So we will see if China limits exports. And by the way, the U.S. calling it a critical mineral, all that metal that flowed back supposedly by tariffs, which it's not, they can just as easily limit or shut off exports out of the United States as well. The president can do it with the drop of a hat without congressional approval. And the fact that it has been labeled a critical mineral tells you it's now a matter of national security and of policy. So,
and of course, you know, we're going to have to go out as a country and buy a stockpile because we ran out of all of our stockpile in what, 2020?
Actually, the government has taken positions in 2 or 3 mining companies up in I think they're up in Vancouver in the Golden Triangle, or up in that area. You have now government stepping in the resource sector the same way they did with General Motors. It's a different thing, but whenever you put government, mix government with private enterprise, usually bad things happen. But nonetheless, it shows you that they are trying and taking very seriously the fact that it's about he or she who has the metals and the commodities wins. It's not just he who has the gold. It's obviously he who has the critical minerals. And one other thing, you look at China, not only do they produce the lion's share in the Eurasian continent of rare earths and critical minerals, but they're also probably they refine upwards ends of 95% of all of the world's critical minerals. We are lacking in so many ways, and looks like the government's now taking things seriously, including silver and platinum, not just the critical rare earths and the critical base metals that you would need to run a country efficiently. You can't be reliant on the rest of the world to provide that for you.
Let's start with the market structure. In a normal contango market, spot prices sit slightly below the front-month futures. As expiration approaches, the spread narrows, both prices meet, and the system moves smoothly into the next cycle. That's exactly what gold is doing. But silver is doing the opposite. Instead of flattening, silver has flipped into backwardation by about 26 cents. And we're only days away from investors deciding whether to roll, close, or stand for physical delivery. Backwardation. This close to expiration almost never happens unless someone urgently wants real metal now, not a paper claim redeemable later. This isn't a one-off anomaly either. Just weeks ago, silver spiked to nearly $3 in backwardation, while lease rates briefly soared to 100 to 200%. A sign of extreme difficulty securing available silver bars, London temporarily steadied itself after receiving roughly 50 million ounces, but the relief barely lasted. As Andy Schectman puts it, that shipment was like patching a leaking pipe with bubblegum and wire. The structural pressure returned almost instantly, pushing the market right back into backwardation. Underneath this market behavior is a geopolitical shift that investors cannot ignore. The U.S. government officially added silver to its critical minerals list, giving the president the power to restrict exports without Congress and signaling the metal's growing role in defense, energy, and technology. China responded quietly but decisively. Every ounce of silver leaving the country now requires government approval. Considering China is one of the world's largest refiners and a major exporter, this move tightens global supply even further. Schectman's core message to investors is clear. The physical market is telling the truth long before the paper market catches up. COMEX and LBMA inventories are being drained faster than they're being replenished. Paper silver is still leveraged hundreds of claims per real ounce, creating the illusion of abundance. And every time spot dips, premiums rise, not fall, proving that physical silver simply isn't available at the official market price. When you combine backwardation, tightening inventories, geopolitical restrictions, and a mining ratio nearing 7-to-1 against gold, you're not looking at a normal cycle. You're looking at a system that has absorbed decades of pressure and is now showing cracks in real time.
If the geologic ratio right now is 7-to-1, let's put gold at 5,000, divide it by 714. So if it's at it's got it, you're talking.
What if we go to Rickards?
Rickard says 24,000. That's the number he says gold will go to when revalued based upon, I think, the M2 money supply and the gold that we supposedly own. Even if you divided that by 42, which is the average ratio between the two for the last 100 years, that's only 571. So yeah, you'd have to see a 12-to-1 ratio at 24,000. It's lofty, but I'll say this. The one thing absolute that I've learned, and there are very few absolutes in the world, especially in finance, there's probabilities, but absolutes are rare. The one absolute I have learned is that markets go higher than anyone ever thinks possible to the upside, and bear markets fall further to the downside than anyone thinks possible. When I started in 1989, 1990, the Dow Jones was around 2,100, and the Nikkei was around 40,000. The Nikkei made it all the way down to about 12,000 and just recently got back to where it was for a minute. I don't know what it's at now. I think it's under that number, but it took a generation to get there. And at the same time, the Dow's gone from 2,000 to over 40. So, you know, who would have ever thunk it? Maybe, who knows? In a world where gold and silver have been suppressed to support the illusion of Western market supremacy, where are you going? And that is what I would say the silver to gold ratio trade is. It's almost a sure thing. It's the best calculated speculation I've ever seen. You buy silver at 88 to 1, knowing it's coming out of the ground at 7 to 1 geologically, 16 to 1 geologically for 5,000 years. Now it's depleting, fallen to 7 to 1. It's disappearing, manipulated by the West to create this illusion of worthless silver to, I believe, support the military-industrial complex's need for silver. No one wants silver. Don't look here. Not about price. It's about everyone realizing its true value. U.S. government just did call it a critical mineral. China did too. The point of it is that it's way out of whack because the West has suppressed the paper price, where 400 paper contracts to every 1 ounce. That's going to end. But even that one great play, you can fumble, you can trip, you can get intercepted. The problem with that ultimately could be, well, maybe gold, like the gold buffalo, you can't find it. I still think it's probably the best trade. It's a trade of a generation, but it's not fail-safe. And the worst thing is you end up with a bunch of silver, which in my mind is a substitute for gold. Right now at 88 ounces, historically 16 should be a lot less, geologically 7 to 1. So yes, but I'm never really a fan about going all in. Maybe put a little bit in gold and kind of dip your toe into it.
80-20 maybe. It's certainly
Every
all
time
possible.
we've seen the price fall to places where it shouldn't be, the reaction of the market is nah, and premiums go parabolically higher than the fall of the spot. Spot would fall by 10, premiums go up 12.
Well, that's what I was going to say. In terms of if you're looking to wait,
There's too
metals
much
to
physical
come in.
demand.
Yeah,
It'll just be gobbled up just like that.
That's what I was going to say. I mean, just like we saw back in March of 23, spot was only 18, 19, 20 bucks around that time frame, but premiums on Eagles then jumped to 20 bucks, 18 bucks over spot.
The big banks that suppress the paper price have to be saying, we get on the wrong side of this and we get a bunch of people saying we want delivery. It's an existential threat. I don't think you'll see it. And if you will, it will be a blip. Back up the truck if you do, but I would say no. Well, silver's $20, a $2 move's 10%.
Right.
When it's $50, a $2 move is 4%.
That's right.
So the higher you go, these moves are freaking people out dollar-wise. But think of the percentage. It's the same thing when people say the Dow Jones is down 400 points. Big deal. That's 1%.
It's nothing.
Right. So
it's absolutely
think
nothing.
of the bigger the number, the scarier the percentage in dollar terms. But in reality, it shouldn't scare you because it's the same percentage.
So here's the bottom line. Gold may be steady, but silver is screaming that something fundamental is changing. Backwardation, lease rate spikes, disappearing inventories, and government intervention all point to one reality. The physical market is tightening faster than the paper market can disguise. Andy Schectman's warning is simple. When physical demand overwhelms synthetic supply, prices don't rise gradually. They break out violently, suddenly, and without a warning label. If you want more deep, data-driven analysis like this, and you don't want to miss the moment things finally break into the open, hit that subscribe button right now. There is a major move coming, and you want to be ahead of it, not chasing it. And now I want to hear from you. What do you think triggers the next major silver spike? Physical shortages, geopolitical restrictions, or a failure in the paper market? Drop your answer in the comments. I'm reading every one.